Hey there, everyone. Welcome to Chart This with Dave Keller. Happy Thursday, May 8th, and welcome to the show. We're coming to you from a beautifully sunny and clear Redmond, Washington. I could get really used to these days here. We're right about at that tipping point where we go from the long, dark days of winter in this part of the country to the long, beautiful, nice and comfortable days of summer. I'm ready. The family's been outside playing with the aerobie most evenings after the show and after everyone's home from school and such. That's pretty good. My Tottenham Spurs, made it to the Europa League final facing Manchester United. I don't know if there are any Premier League fans. Long story for a separate thing, but I'm a Tottenham supporter on top of our local Seattle Sounders here. Always good to see your team make it into the finals. But welcome to all of you. A nice update for stocks. Not a great finish to the day, though. It's like, just when you're ready to just get all excited, all pulled up, just confident that the 200-day moving average is going to be left in the dust. We have this rollover in the last hour of trading, similar to things we've seen here earlier this week. It's just like that last piece, which you just want to feel great about, feel like that's snatched right away. A doji candle erupts for the S&P 500. Pullback in gold. I've already seen some comments on that. We'll definitely, get to that. I don't remember if I grabbed the chart of gold, but certainly something I want to go through. I was on the interviewed earlier for the Financial Sense News Hour with Jim Poplava, who's an awesome longtime money manager and market strategist, and we talked a good deal about gold after the run that it's had. With that in mind, shall we get to the charts and see how things played out together? Sorry, I was lamenting about the chart of the S&P earlier. I had it queued up. Let's get to the market recap and see how things played out. So again, our general strategy to the show, if you're new to watching, and thank you guys for tuning in live on Facebook, LinkedIn, YouTube, and X. We'll start with the market recap. We'll look at the heat map, which we call the heat map visualization. The market carpet on stock charts allows us to look at all 500 S&P members. It's actually about 505 stocks at the moment for the record, but we look at all of them in one visualization. Then we'll look at a series of charts, which I think are key charts to pay attention to follow the changing conditions here. Then we'll get to some questions here and wrap it up for the evening. Major averages, again, a strong up day. And if the last 30 minutes it didn't happen, I would say it was a remarkably strong day on any measure. Breadth overall has been strong, decent today. Major averages moving to the upside, all that happened. So again, I'm struggling to find a lot to not be super encouraged about. Last 30 minutes is probably one of those pieces. Having said that, the S&P closing above 5660 all the way to almost 5664 at the close was up as high as 5720. That is remarkably close to the 200-day moving average at 5750. Did not quite get there, but was rapidly approaching around lunchtime Eastern time. That close with the pullback at the end of the day does leave the S&P 500 up about 0.6% from Wednesday's close. The NASDAQ composite up 1.1%. The Dow about the same as the S&P, up about 0.6%. Mid caps and then small caps. Look at this. Small cap S&P 600 index up about 1.8%. That is a strong upside move in small caps, an area of the market that has not been known to outperform here so far in 2025. The VIX moving lower, just over a point. We're at 2250 on the VIX, still, sort of in that limbo between 20 and 30, which I sort of loosely classify as still high volatility. Any VIX below 20, though, is pretty low volatility, and that sort of implies bull market conditions. So we're just so close. Again, I mean, as we test the 200-day, we're very close to a break above the 200-day, to the VIX breaking below 20, to the breadth indicators, particularly longer-term breadth indicators that have started to improve, really probably accelerate to the upside. Momentum looks better. Volume hopefully improves. Very close to that all clear kind of configuration. Just not there yet, right? And so I'm not ready to anticipate that's going to happen. Still plenty of reasons why the market could and maybe arguably should go down. But boy, we are following headlines in a trade deal with the United Kingdom, noticeably lacking of a lot of detail at this particular moment, but assuming that detail comes and we get some specifics behind it, certainly some encouragement and hints of further deals coming along the way. So we shall see. looking at some other asset classes. Had a really, really fun interview earlier today for the Market Misbehavior podcast, an episode which we'll release probably tomorrow morning with Urian Timmer. Urian is the director of global macro at Fidelity Investments. My office and Urian's office were about 3 doors away for a while in my Fidelity days. And he's a fantastic technical analyst and macro strategist with a wide following in social media, and also a wide following within the Fidelity complex with the portfolio managers who have followed his work for many years. Just hit 30 years at Fidelity. He's a smart guy with great experience and some fantastic market insights. I hope you'll enjoy that episode. But we did talk about fixed income quite a bit, and he reminded me of one of the things I learned in my time at Fidelity, which was fixed income investors, bond investors, tend to be way more focused on risks. So when things get uncertain, it's always helpful to talk to the bond investors within a larger firm, because they're the ones that are just laser focused on potential downside, potential risk to companies, and their ability to pay off their debt. All of that becomes more important. In bull markets, like, you don't need that because everything's great. But then when things get a little rocky, when things get uncomfortable, leaning into that side of the market has been very, very helpful. I hope you can enjoy that interview when we get to it, when we release it here very soon. But in the meantime, let's talk about the bond markets today. Bonds continuing to move lower. So stocks up, bonds down, dollar up. You can see the dollar index using the UUP, one of the biggest moves we've seen in the dollar index in a while, up about 0.8%. The TLT, which is a treasury bond ETF, down about 1.1% today. Interest rates generally moving higher. The 10-year yield finished today around 4.37. Long bond yield above 4.8%. 5-year point almost above 4%. Briefly kind of pushed above there a little earlier. But a nice move lower in bonds, and rates moving higher, kind of normalizing the shape of the yield curve if more of those days kind of happen. Now, the commodity space moving higher if you look at the DBC. Now, the main component to the DBC is the energy side, particularly crude oil, and crude oil had a really nice up day, up about 3.3%. That's using the USO. What did not move higher today was gold. The GLD down about 2%. There's some challenges to that gold trade, and I would say one of the biggest risks is, and I guess it's a question, right? How much of that upswing as gold blew through $3,000 an ounce up to $3,300-ish an ounce, how much of that is a safe haven play, is investors going risk off and getting into hard assets? How many of those assets go back to risk assets if we start to break out further than what we've seen? I would guess probably the biggest risk to the trade in gold is a resumption and uptrend in equities, to the degree that people like me don't want to fight it anymore and have to acknowledge that the S&P back above the 200 days, a pretty good chart all of a sudden. So I think that gold trade has some risk to it. I'm keeping an eye on some downside short-term objectives, which we'll talk about in a little bit. Still a good chart though, right? I mean, if you look at the medium term, look at the long term, applying my market trend model to gold, not a bad chart. But again, we'll talk about that a little more as we get to the chart component. Natural gas down slightly. Crude oil prices up. The energy sector doing okay today. One of the top 3 sectors. I'm remembering my conversation recently with Rob Thummel, who's an energy portfolio manager. Really appreciated his take, stretching my thinking about the energy sector, not just about direct plays on crude oil, of which there are many, but looking at energy infrastructure, natural gas pipelines, other areas of the market. That theme came up in my interview earlier today with Financial Sense NewsHour. So certainly maybe something there. All right, looking at the cryptocurrency space, big update. Bitcoin above 100,000. I'll say it again. Bitcoin finally getting back above 100,000, up another 5% today. Cryptos really have been generally in a bull market phase. We do own Bitcoin and Ethereum in our own accounts. Ether price is up significantly today, up about 20%. Number of news headlines, which I don't have time to go through all the details, but a lot of things coming in today, or in the last 24 hours, certainly. We talked about earlier in this week, we showed the chart of how Bitcoin was basically a leverage play on stocks. And what I mean is, Bitcoin outperforms, and we were looking at the IBIT, which is the iShares Bitcoin ETF, outperformed in January into the February peak. from February down to the April low, Bitcoin, the IBIT underperformed the S&P and the NASDAQ during that period, and then back to improving on the way and outperforming on the way back up. So upswing, downswing, upswing. Bitcoin has basically done better than the S&P and the NASDAQ on the way up, has done worse on the way down. So really it's just an exaggerated speculative play on the same speculative forces driving equities here. So if you're bulled up on equities, Bitcoin basically doing what equities are doing, but it's almost like a leveraged long ETF. For now, Bitcoin currently above 102,000, 102,300, we'll call it. And again, as a trend follower, I think the chart is strong. We're rapidly approaching the previous all-time high from earlier this year. Certainly something to keep an eye on. All right, looking at the 11 S&P sectors, I mean, not a great day, but if you look at the bottom of the list, it's the 4 defensive sectors that were down today, right? Starting at the bottom, you have healthcare, utilities, real estate, consumer staples. Those are the 4 sectors in the red. Those are pretty defensive sectors. The sectors at the top of the list, not the FANG sectors, but rather the value-oriented sectors, what we call the cyclical sectors. The MEI trade, materials, energy, and industrials. Those are your top 3 sectors, all up about 1.3% to the day. We're going to focus a little bit on the industrial sector, top performer, and some really encouraging charts in there from airlines breaking above their recent swing highs, getting above moving averages, to some of the traditional industrial players, even things like Cintas and others, breaking to new swing highs. So a lot of different groups doing a lot of good things in the industrial sector. We'll let the charts speak for themselves here in a little bit, but it's noticeable today for me. It's not the FANG sectors. I may be the only one still using the FANG acronym, but I like that one a lot. The Mag 7 sectors, I guess we'll say, they're kind of middle of the pack, right? They're sort of in the middle. The cyclical sectors, the value sectors did better. The defensive sectors did worse. Is that a theme that sort of plays out in May, June, July? Value over growth? Do we get a bull market driven not by growth leadership, but value leadership? Definitely a possible scenario here. Looking at the breadth today, again, another really good day breadth-wise. You can see for the S&P 500, 70% of the S&P higher, 30% lower. In the NASDAQ, about the same, right? Two up for every 1 down. Same with the New York Stock Exchange. So these are decent, upside breadth numbers, and we've seen that pretty consistently through recent weeks here. I think that's, one of the more encouraging things I've seen has been the dramatic improvement in breadth. That's things like the advanced decline line on the S&P making a new all-time high in the last week. The McClellan oscillator getting above 0 and basically staying there. The bullish percent indexes getting to extremely high levels. And while that short term tells me maybe we're due for a pullback, overall, it tells you we're in a position of strength with a lot of things generally going higher. The Zweig breadth thrust, which we talked about on the show, came up on a Friday mailbag episode, maybe 2 weeks ago, I want to say. Fired. We had one of those. We haven't had one of those buy signals from the Zweig breadth thrust in quite some time, and that is based on very weak breadth turning into very strong breadth in a very short window of time. That's what Marty Zweig identified, and that's the inspiration for the indicator many of us still watch today. So, one of the more bullish piece of evidences that I can tell you about are these breadth numbers remaining where they're at. Daily advancers decliners start to turn more red and start to have more stocks down than up over a consistent series of days. That's where you start to question the sustainability of this uptrend. But for now, things kind of continue to work. When you look at the Magnificent Seven stocks, though, and again, these are not generally the leading names. It's in other sectors today. For what it's worth, Tesla having a pretty decent day, up 3.1%. That's still a pretty ugly chart, I would say, from a technical perspective. Still trying to get above 290 and not quite doing it, but something to watch. Alphabet got absolutely clobbered yesterday. It was down, 7-8%. So we're up 2%. That's great. We made about a third of the way up of yesterday's candle. So let's not get too excited about today, but nice upside rebound after yesterday. Amazon kind of dribbling higher, still trying to get above the 200-day moving average. The only one of these stocks that was down is, without a doubt, the best chart of this basket, Netflix, down about 1% for the day. Boy, a lot of interesting. Meta kind of flat, right? So, you know, again, if you're looking for, I think a lot of investors probably are waiting for Meta and Apple and Amazon kind of, you know, leading the way again. Um, Not seeing that yet, folks. All right, that's it for the market recap. We're going to get to the heat map here and look at how things are playing off. As a reminder, we're live streaming on Facebook, LinkedIn, YouTube, and X. I appreciate you guys tuning in live in any of those places. I'm seeing activity on comments in each of those platforms, and that's great to see. So please please put questions in there as we go along. At the end of the episode, I'll try to take a question or two before we wrap for the evening. Any of the questions we don't get to, we'll put them in the mailbag. We're planning an all mailbag episode tomorrow. Those Friday mailbag episodes have been a lot of fun. Some really great questions. Gives us a little more time to give some thoughtful responses to some of your great questions we don't have time for through the course of the episode. And if you're watching the show on our replay on our YouTube channel, just put a comment or put your question in the comment section. We'll get to it when we'll get to it when we can, for sure. All right, looking at the heat map here. I mean, honestly, more positive than negative, but it depends on what sector you look at, right? So, you know, obviously some really decent sector performance. I mean, the industrial sector just immediately stands out to me, right? If you look here, and there are a lot of different businesses represented in the industrial sector, right? Some sectors are pretty homogenous, meaning they're, you know, kind of similar with some, you know, subtle differences, but they're very similar. Industrials are a very diverse, very diverse sector, right? You've got transportation names, right? Like airlines, like trucking companies, railroads. You've got conglomerates, like 3M. You've got defense stocks and aerospace names like TransDigm and Boeing. You've got delivery services like UPS and FedEx. Heavy construction names. I mean, you got a whole bunch of different things, but on average, this sector did quite well today. And each of those groups that I just mentioned probably has some names had a pretty decent update. Boeing up over 3%, John Deere up over almost 4% today. Generac making, I'm blanking on what they are. Generators, dear Lord, David. Generac. Again, even the charts like Generac that have probably been some of the worst charts in the sector, starting to get a nice rally off of the recent lows, making a new 1-month high. So a lot to like in that sector. And again, that's probably a sector many of us have not been thinking about too much because all of our attention has been on things like growth stocks, but industrials not too bad today. Other sectors showing some strength. Materials, of course, as we mentioned, Newmont is the only gold name in the S&P 500 at this point. So that's the only red box at the moment. The rest of those all kind of neutral to quite positive. Where else? In financials, right? Goldman Sachs up about 2.5%. American Express up 2.7%. Nice upswings. Underwhelming sectors or sectors with a lot of weakness. Healthcare, and I feel like that's been my main first example when I say which sectors are not looking good. Boy, healthcare is it. I mean, the XLV, not a great chart, particularly on a relative basis. Probably energy, the only one that's less awesome about, looking in 2025. A lot of pharmaceutical names continuing to get pushed to the downside. Today we have Eli Lilly down another 3.3%. McKesson down about 4.5%. McKesson's arguably one of the better charts out there. The problem with charts like McKesson is you make new highs or you retest the previous high, but the momentum completely dries up, right? So here I have a classic bearish momentum divergence. We're overbought in early April as we make new highs. We are not overbought as we retest those highs about a month later. So that pattern of higher highs in price, lower peaks in momentum, called a bearish momentum divergence, something you look out for after an extended bullish phase. Look for that sign of the trend continuing, but on weaker momentum. It's a kind of chart you want to hold off and maybe either take some off the table or look to see where things pull back to. But a lot of those healthcare names struggling here in recent weeks. Not all bad. There's some random names kind of doing okay, but they're not great charts, right? A lot of these charts are ones bouncing off of fairly low levels here recently. Utilities, real estate, consumer staples. These are three of the defensive sectors. The defensive sectors, along with healthcare, at the bottom of the return list today. And it's some of the big names and consumer staples. They're having the toughest time here. So you have Walmart pulling back after testing $100 a share. Coke, pulling back as we're, attempting to break out from a beautiful cup and handle pattern, sort of stalling out in an attempt to break to new highs. Tobacco stocks like Philip Morris, arguably some of the better charts you could find in 2025 anywhere, down about 2% today. So definitely getting a sign of, at least for today, rotation from defensive sectors, which have been outperforming here in the last month or two, going into today, or going into this month. And then defensive sectors on a relative basis pulling back. Two sectors having the best relative performance in the last month: technology and industrials. And that's not just today for industrials. That's actually been building for a little while. I did grab the relative performance of industrials here in a moment. Last thing I point out is obviously within the technology sector, a lot of interesting charts in here. A lot of the charts that are up a lot today are ones bouncing off of very low levels. It's not the leadership names like Nvidia, or previous leadership names, I should say, like Nvidia. Intuit, one of those names, probably an outlier in a very good way. Here's the chart of Intuit. I didn't grab this chart, so I just wanted to show it powering above the 200-day moving average and pushing higher. I like a chart like this because instead of bouncing up to the 200-day and pulling back, we power through it. The momentum improves where the RSI is pushing above 60. That's actually a very good sign at this point, because it usually implies new buyers coming in willing to pay a little bit more. It's making a new three-month high today, which is how it pops up on my radar pretty quickly. So overall, some interesting kind of random one-off names within the within the technology sector for sure. All right, we'll finish off looking at the charts of the S&P and among other things. I do want to let you know, as a friendly reminder, my friends at Seeking Alpha have a special going for the spring, $30 off Seeking Alpha Premium, and they also will throw in their next Alpha Pick, which is where they hand select one of their top ranked names using their proprietary quantitative model. I put out some videos about how I use different parts of the Seeking Alpha platform. They've been great partners to the channel and supporters of Market Misbehavior. So check it out if you want more information on their Seeking Alpha Premium platform. My favorite parts of that platform are the quantitative model, which is an institutional quality model designed really for individual investors to help you identify companies, showing the characteristics of good companies in previous cycles. You can learn more at marketmisbehavior.com/seeking alpha, or just scan the QR code to the right of my face on the screen. All right, let's go on. And I do want to share on social media platforms, and you can follow me on X at DKellerCMT. I always try to throw some random charts during the course of the day when I'm not doing something else. I had a poll question running this morning. I just grabbed it. It's still open if you want to go and be a part of the poll. But I asked, which happens first? The S&P breaks above the February high, which would be above 6150, or below the April low, right? Which of those two things happens first? S&P over 6150, S&P below 4850. It was pretty split for a lot of the morning here as I was looking at the end, 55% basically saying up, 45% down. So we're leaning about a 10% spread, bulls over bears, according to that survey. Now, what you have to remember is the February 2025 high, still quite a ways away, right? We're about 400 points below that, getting up to 6150. 4850 feels like a long way down. One of those levels is going to break at some point. And which breaks first? I'm starting to think a lot more that maybe 6150 breaks first, but I don't think that's a straight line. I don't think we just go from where we're at today to 6150. And I feel like that's how a lot of traders are sort of expecting this to go. We are so obviously going to go up to that point. But boy, I feel like there's a lot more volatility to be had there. So you check that out. Follow it on X at DKellerCMT. Vote in that poll. We'll keep other polls going. Always welcome your votes. All right, let's look at some charts together, shall we? The S&P 500. This is a doji candle. That's where you have the open and close right around the same levels. It's not great. I mean, the quick version of that is usually tells you the next 1 to 3 bars are lower. Or really, it's telling you the reversal. So if the primary trend is up, which it is, that says the next 1 to 3 bars probably lower. If you'd see a doji candle in a downtrend, it tells you the next 1 to 3 bars would be higher. So that's sort of a short-term reversal candle, basically saying we've digested that recent move. We probably pull back a little bit. We're right. I mean, we are right at the 200-day moving average. Earlier today, it looked like we might actually break above it today. The 200-day moving average is right here at 57.50-ish. That lines up really well with this candle pattern back here. This is called an evening star candle pattern, where we have a big up day, kind of a little doji-like day, and then a big down day, three bar pattern or three candle pattern. That happened at the 200-day moving average there. So we'll see what happens. Again, I think the S&P above 5,800 is a remarkably bullish setup, right? I mean, it's just hard to remain anything, I mean, any sort of bearish at that point. Well, again, we can make the arguments as to why the market should or could go down from a technical perspective. I don't think you can fight it at that point. Having said that, I think that's a big ask for the S&P to continue this incredible rally where we've basically erased all of the negativity from the tariff announcement. We literally closed at about the same point that we closed the day before the big, tariff tantrum, as it were, exploded, was unleashed on the markets in early April. One of the things I talked about with Urian today, which again, when that interview comes out, I think you'll appreciate. I asked him about, is this the Trump put, right? And the idea is we should talk about a Fed put, that if conditions get to a certain point, the Fed kind of comes in to save the day with liquidity or with interest rate policy. Here, you kind of have the Trump put. This is the level at which the president decides he's going to start making some other announcements and hopefully change the trajectory of things. That's the pain, which probably means if and when the S&P does get back to that down to that level, I don't know how you're not a pretty big buyer at that point. I mean, just using the weakness to bet on that sort of level being where the panic button is pushed and things reverse to the upside. I think there's a decent argument to be made for that. So for now, again, I think the S&P, the 200-day moving average is key. We've got the swing high from late March. Again, I think we're in that yellow light space between 5,500 and 5,800. I think the S&P below 5,500 is pretty bearish on the tactical time frame. I think the S&P above 5,800 is pretty encouraging. For now, we're kind of right about in the middle. We're in no man's land. The short-term breadth, as we've covered, I think pretty closely, continues to be quite strong. The McClellan oscillator remains above zero. That tells you in the short term, the breadth is more positive than negative. We've had a lot of days like this where there are more stocks up than down, random days that are doing the opposite, but this has been the general theme during this period here, certainly in the last 3 weeks. The McClellan oscillator turned bullish second week in April, remains bullish for now. When you're thinking about a market in a short-term uptrend, I'm always looking for signs of a rotation lower. And besides just using a specific level on the chart of the S&P, drawing a trend line off of the lows, that kind of thing, looking for something like the McClellan oscillator to turn negative can be a good sign that the trend is rotating lower. At least the breadth is starting to rotate to the downside. This is one of the breadth charts we track as well. We now have over 60% of the S&P 500 members above their 50-day moving average. The S&P itself has regained its 50-day in the last week. It's pretty bullish. That's up from around less than 10% at the April low to now over 60% about a month later. So you've seen over half of the S&P break above their 50-day moving average. That's short-term strength in breadth terms. The long-term breadth is still not quite there. We're still below 50% of S&P stocks above their 200-day, but we're getting closer and closer. So I think the way that this market resolves in a very bullish way, we power above the 200-day. This indicator gets above 50%, which would then pivot, change that script and say now most stocks are above their 200-day. I think that's where sustainable gains probably begin. The newer Dow theory we haven't talked about in a while just because there hasn't been much to talk about. Going sort of early April gave a pretty major sell signal as both of these, and that was in March actually, when both of these made a new swing low, and that basically suggests deep downtrend. On the opposite side of that, we have almost a new buy signal according to newer Dow theory, and that's when both of these would make a new swing high. Problem is you have to get all the way back to these March peaks in terms of how I would read the indicator, which means we're very close but not quite there. The equal-weighted S&P, equal-weighted NASDAQ get above that March swing high. I think this chart looks pretty constructive for the first time in a couple months. All right, it is Thursday, which means we've got some weekly sentiment data to parse through. Let's go quickly through these. The AAII survey way more bullish this week. One of the things we've talked about is that the spread between bears and bulls has been around 30 to 40% for a while now. It's actually down to around 22%. That still means there's still a lot more bears than bulls, but it's less than a 2-to-1 ratio, which is a dramatic improvement from what we've seen here. Right now, about 29% bullish. That's still way below any sort of real bullish reading on the indicator, but it does indicate some renewed optimism from individual investors that have generally been skeptical of this April into early May rally. Bears still over 50% bearish, which is pretty consistent to previous market declines, but I think continued improvement in that indicator should give further validation to upside. This next one's even more encouraging, which is the name exposure index. Last week, we reported that the name exposure index was around 60%. The week before that, it was around 40%. So we went from 40% 2 weeks ago to 60% last week to 80%, 81% as of today's reading. So the weekly data, and this is a survey of money managers asking them, what's your allocation to equities? So 2 weeks ago, we're 40% weighted in stocks. Today, we're 81% weighted. So that is a big increase in allocation. That means, according to the long-term averages, we're just above the average reading on that indicator. So money managers in this survey, similar to what I've talked about looking at the chart of the S&P, starting to take defensive bets off the table and rotate to more risk-on type of positioning. Most bullish thing you see is that indicator continue to go higher, indicating that money managers are putting money to work and betting on further upside. All right, looking at the chart of Bitcoin, we are back above 100,000 per Bitcoin, and that hasn't happened since the beginning of February. That's the last time we were up around these levels. Now, if you want something to be concerned about, look to the left on this chart and see that we were rapidly approaching our previous all-time highs. We hit 108,000 for the first time ever in December of 2024. About a month later, in mid-January, we briefly ticked above there. It's around 109,000. Didn't quite get to 110,000, but very, very close. From there, it rotated down to the lower end of the base and then broke below that support level. And that was one of the sell signals we highlighted back in February. From there, we deteriorated all the way down to around 75,000, but that's been the low. So as stocks bottomed out in early April, as did Bitcoin, on the way back up, Bitcoin has regained the 200-day moving average, broken above the swing highs from March. That for us was pretty bullish confirmation. From there, it's been lights out upside, some gentle sort of uptrend over the last couple of weeks, but today accelerating to the upside up above 103,000. We do have a position in Bitcoin, also Ethereum, which is our next chart. Not planning to do anything with that position for quite some time. That's a long-term holding, but I would say on the tactical time frame, if you've ridden this price up, pretty reasonable to expect at least some sort of pullback as we retest previous all-time highs. The real question is, do we continue to follow through above there? Now, it's worth noting on that last run up to 108,000, we had a beautiful bearish divergence, right? That last high was marked by weaker momentum. That's something I'll be looking for as we reapproach those highs, right? We're overbought here as we push above 100,000. Do we make a subsequent high on weaker momentum? That could be a big argument for a major peak, and I would take a look there. Ethereum rotating higher aggressively. We're up around 2,200. We're back above 2,000 for the first time since March. That's a nice follow through, and Ethereum has been underperforming Bitcoin for the year 2025, down quite a bit, while Bitcoin is retesting previous all-time highs. Previous all-time highs for Ethereum from December are all the way up at 4,000. That's almost a double from where we sit today. It's a double from yesterday's trading range. So, is Ethereum ready for a catch-up trade? That is something that's, I think, more of a structural debate about the Bitcoin and Ethereum networks, et cetera, et cetera. Probably I need to find a good crypto expert to get on my podcast. That's on my mental list. I'm actually going to write that down, and we'll see who we can find. If you have any particular crypto experts that you find valuable or that you think would be helpful for me to ask some fun questions with in a laid-back manner on the Market Misbehavior podcast, let me know. Drop a comment wherever you're watching the show, and I'll see who I can find. I have a couple ideas in mind, but let me know if you have any specifics whose opinion or insights you found valuable. So from a technical perspective, this chart breaking out of this range that we've been in the last couple of weeks, pretty bullish. breaking above the March peak, pretty bullish on a big up day like this. It's all about maintaining that high. So I would use 2100, which was that resistance from March. You want to see that hold on any pullbacks for now, and that would be a pretty constructive chart there. Now, if you're not into setting up digital wallets, if you're not really looking to have an account that holds those things directly, the good news in 2025, there are now ETFs that track Bitcoin, like the GBTC, like the iShares ETF, IBIT. Or you could just buy something like Coinbase, right? That's one of the companies that essentially is a direct play on the cryptocurrency space. Coinbase, not the best chart out there. I won't lie to you. I mean, it's not a bad rally off of the lows. What's happened is it's stalled out at that March peak. So you see Ethereum breaking above the March high, Bitcoin blowing it out, Coinbase kind of stalling out there, still below a declining 200-day moving average. I think a little more to prove from a technical perspective. What is encouraging, though, is the volume. So you can see the Chaikin money flow in the bottom panel turned from a distribution phase where it's below zero to an accumulation phase. And actually happened before we made a low. It's one of the reasons why I really like this indicator, because it captures buying, it captures accumulation while the price is still going down. It sort of indicates, or it recognizes, that we're having these up days during the decline, which probably indicates some early buyers coming in and buying on weakness. We're now in a period of accumulation here for the last month. Keep an eye on that one. All right, Palantir, I have this chart up for one reason and one reason only. We've talked about it from a technical perspective. It is retesting all-time highs at around 125. I have to acknowledge that's a strong chart up at, above two upward sloping moving averages. But look at the valuations, right? This is trading at a 520 multiple, right? You're paying $520 for each dollar that the company actually earns. I don't know about you guys, and I'm not a fundamental analyst, but that seems like a lot. And if you look at the average PE ratio, it's pretty extreme, even for a growth stock these days. So I think the challenge for Palantir is you're buying on optimism about future growth and earnings, none of which have been reported on any sort of financial statement. This is all speculation going forward. Now, markets can rally many, many times over on speculation and anticipation of future earnings. And stocks generally trade at a premium to their earnings, right? Which is why PEs are not one. They're usually multiples of one, because you're willing to pay multiple dollars for earnings and potential growth earnings. But over 500 for a PE is probably a pretty tough one. A nosebleed, Larry, as you said on YouTube just now, and I would agree. So if you look at valuations, you're probably never going to touch a Palantir. From a technical perspective, breaking above 125, clearing that February peak would be pretty meaningful for sure. And the momentum is strong, the relative strength is strong. All of that is true. But again, at what point do those valuations seem too extreme? You're not seeing those sort of valuations in sectors like industrials, for example, which is what we're going to talk about right now. Here are the 4 defensive sectors. This is a chart that I have on my market misbehavior live chart list. You can find that list of charts at marketmisbehavior.com/charts. It'll give you to a free page within stock charts where you can see my latest chart list, all updated randomly when I have time to do so. But basically a key list of charts that I review every day, and begins to be the inspiration for what we talk about on the show every afternoon. Here is the relative performance of the 4 value sectors: industrials, financials, materials, and energy. Energy has been underperforming since early April. Since early April, materials have been slightly underperforming, and financials have basically been flat. They've essentially been in line with the market. But industrials definitely the outlier to the upside. And 2 sectors really stand out in terms of improving relative strength from early April to early May, and it's industrials and technologies. Now, we've talked about technology regularly on the show. We often grab a tech name or two as we're looking at the charts. But let's talk about some of the industrial names. Here's Boeing making a new 3-month high. This is one of the reasons why I run a screen for stocks making new 3-month highs, because names like Boeing immediately jump out as, wow, Boeing has been such a brutal chart in 2025, but did you know it's making a new 3-month high, which it is. So we have Boeing breaking above 188. That's clearing the peaks from a number of times, really going back to like 182 or so from late December. We can see a number of failed attempts to get above there. Is this one different? Are we finally powering above there? And it certainly seems to be an encouraging breakout. John Deere not quite making a new 3-month high, but very, very close to doing so. We've gone from a period of lower lows to higher lows. This is the kind of chart where I think you can draw a trend line off of those lows and have a pretty good sense of the uptrend and the acceleration that you're seeing off of those lows. And as long as we hold that trend line, it tells you that short-term theme is still working pretty well. Axon Enterprises, a gap higher today, up about 14%. This is one of the top performers in the S&P. This is a defense name. The challenge with this stock is it's rallying up to a very well-defined resistance level. You look at the December peak, it's right around 700. The February peak was basically a retest of 700 before a break lower. We retest the 200-day, we pop higher, and now we're back up to those to that resistance level. So the short-term trade has been pretty impressive. Note the big bullish divergence as we tested the 200-day. That's why we watch for that particular pattern. But now what's next? And I think at this point, I would probably be patient and wait for a break above that level. You want to see, at least I want to see, signs that buyers are willing to pay more than 700 for the first time. That's not what's happened at these previous peaks. Previously, we've gotten to this point, and this is where there's an exhaustion of buyers. Is something different this time? The chart will tell you when. That's why I would set an alert for that one breaking above 700. I'm writing that down, by the way. All right, Cintas, CTAS, making a new 3-month high today. This did pop up on my screen. Not a great candle today, though. It was actually like a shooting star candle with the open and the close near the lows for the day, but it did clear 210. So the way that I kind of approach this kind of chart from a technical perspective, that's your entry point where we break above the previous swing highs at 210. That's your initial stop, is probably down around the 200-day, but as we make progress, maybe your initial stop is here at the entry point at 210. And then there's your complete stop at 203, right? So you would take part of it off. If we break 210, you take more off there. We break to new all-time highs, maybe you add to the position. But thinking of it in terms of scaling in on further strength, lightening up on weakness is the way that I would use the chart to kind of clearly define some levels. I saw some people making comments about my interview or my conversation with Grayson Rose. That was earlier this week, I want to say. It's a bit of a blur. Might have been last week, actually. It was last week. We did our top 10 charts to watch for May 2025. Shot that in the Stock Charts TV studio. It's on the Stock Charts TV YouTube channel. But we did talk about a number of things. And Grayson actually showed, he uses a series of horizontal lines on his stock charts to identify entry points, risk levels, levels at which you add to positions. I thought his way of doing that, which I don't do, but I thought his was really well defined, made a lot of sense to me. Another group within industrials, airlines. You can see Alaska Airlines, that's the biggest carrier here in the Seattle area, breaking above $50 this week, powering above the 200-day moving average today. So $50, kind of that initial stop, I would say. As long as we hold that, that's a pretty good chart. The RSI pushing above 60 this week. That's all encouraging. See if we can get further upside and maybe a retest of those previous peaks. All right, looking at a couple other charts, and then we'll take some questions and then be done. I'm running a little long on time. Sorry about that. JP Morgan making a new monthly high, breaking above the March swing high. I like the action that I'm seeing in the financial sector, particularly banks like JP Morgan finally getting above some of those March peaks. I think that's pretty encouraging entry point. Disney, which is one of the few individual stocks that I do hold pretty consistently. I've got a position in a retirement account on Disney, bouncing off of those long-term lows, gapping higher on earnings this week, trading higher again today. So a gap and run is what it looks like. Similar to the chart of Microsoft, by the way, which I didn't grab, but I'll show you what I mean. The chart of Microsoft is featuring what I call the gap and run pattern, right? A gap higher, and then you see additional upside movement afterwards. You're seeing the same kind of thing on the chart of Disney. That's encouraging, right? That means that buyers are willing to pay even more. Even after that upside gap, that revaluation to the upside, even more optimism coming in. We'll take it. Finally, and I say this kind of in jest because Dave Inc., ticker Dave, is not one that I follow often, but my friend Grayson posted on social media, Dave making a new all-time high today, up over 40%. I'll take it. Good to have a ticker with your name. This is one of those smaller kind of bank apps that is having some remarkable growth, and their prospects look pretty good, gapping higher pretty significantly on earnings. I'll take a breakout in Dave. I'll take that anytime. All right, let's get to some questions here. And thank you guys, as always, for lots of questions, for lots of comments. Sounds like the general agreement on Palantir being aggressively overvalued seems to be pretty good. Thanks for a couple cryptocurrency experts. I'll look into some of those for sure. 3P Investor, a frequent viewer, and I appreciate you commenting. VIX is decidedly going down. If it goes below 20 and stays there, one has to consider that as a positive sign. No, is this why money managers are plowing in? Is there a correlation between AIM and VIX? Yes, those sentiment indicators in the VIX. Oh, a couple pieces to that question there. Interesting. If the VIX goes below 20 and stays there, is that a positive sign? Undeniably so. I would 100% agree with that. And again, there's no doubt I've been pretty cautious about the market moving in an uptrend. My market trend model is still bearish, and that it only has two settings, bearish or bullish. It hasn't been enough of an upswing because the sell-off was so significant, and I've seen this happen many times, so I'm not that rattled by it. The next upswing, if it's a V bottom, can take quite some time. I remember that from the financial crisis. I remember indicators like this getting really bombed out and taking a while to recognize the bounce off of that 2020 low. But again, being patient to confirm that that was a recovery and that the financial crisis wasn't still going, because it was very unclear at that point. I kind of learned to be very happy being patient in that environment and then waiting and seeing. Yeah, I mean, one of the most bullish things you can see, things that would validate the fact that the market probably continues a lot further than what we've seen so far. VIX getting below 20 would definitely help. I mean, this market, certainly in the last couple of months, has been marked by extreme volatility, right? You can see the change in volatility, right? From the first 6 weeks of the year, kind of continuing the volatility that we saw in the at the end of 2024. And then all of a sudden it just accelerates to the upside. And that wasn't even the tariffs. That was just the market coming out of the February peak, right? I mean, the markets were selling off before the whole tariff thing. It feels like that was the cause, but that was actually a little further, was when we actually had a tariff announcement and saw the sudden downside shift in stocks and the upside shift in the VIX. So yeah, getting back to a low volatility environment, absolutely right. I mean, how bearish do you want to be with the VIX below 20? I don't want to be that bearish, and I certainly would want exposure to the long side if we have low volatility and we have stocks doing what they're doing and continuing. 100% true. Is there a correlation between some of those sentiment indicators and the VIX? That's an interesting question. I don't have the hard statistics, but I'm going to jot that down, and that'll be on the rainy day list of things to dig into. I'll report back if I do that analysis. I've not seen anything that has really done that. I have a couple questions on the commitment of traders report. Do I ever look at it? To be honest, I don't, and I probably should. I kick myself anytime I talk with like Larry Williams, who swears by the commitment of traders and has made, in some ways, he's made a career on a lot of things, but would often refer to the commitment of traders report. Not something I look at very often, particularly looking at the dollar, looking at commodities, looking at stocks potentially in different areas. Certainly something, not something that's part of my normal toolkit. I will make a note to talk to some people that are commitment of traders people and get their take on things. I appreciate you suggesting that. Patrick, thanks for watching on YouTube. What are your thoughts on Micron still staying low, even though the financial reports show them having a great first quarter with some good potential? That's a great question, Patrick, and thanks for watching. So listen, the charts that are really impressive, they're not generally growth stocks necessarily. And when I think of the names that I'm most immediately drawn to, I mean, semiconductors are not really on that list. Nvidia is not really on that list. I mean, charts like Nvidia still below the 200-day moving average. Charts like Micron have been absolute disasters, still well below their 200-day moving average. I would say AMD kind of in a very similar situation to Micron, making a nice counter trend rally. AMD with just a brutal shooting star candle today, so closing at the lows for the day. I mean, just the problem is these were stocks that were really underwhelming going into the February peak. They kind of held up okay, but then this breakdown here was kind of it. So while we're talking about some things testing new all-time highs, Micron has basically just come back to the tariff gap that we see from the first week in April, and that's it. So, is there enough upside follow through to tell you this is a really good chart from a technical perspective? I would say no. Earnings are a bit of a head scratcher, and I haven't looked in detail on Micron's earnings to make a good assumption on that. I would say most companies beat their quarterly earnings report. I think that's less about them having remarkable quarters, but more that our expectations get drawn down. So they beat a very downgraded expectation. It's sort of like if you bring the bar low down enough, it's a lot easier to sort of get above that bar. That's kind of what's happening with quarterly earnings. And that's a very known bias with quarterly earnings reports. It's the forward-looking expectations that I think are so meaningful. Most bullish thing a chart can do is go up. And I think Micron and charts like that, making a higher low and then accelerating above the 200-day, for me, like those are the charts that I'm going to look for as more opportunities. And again, the good news is you're seeing charts that are actually able to do that. Will the S&P do that? That's going to be the big question going forward. We'll continue to watch the evidence every day and report to you on this show. And I hope you can continue along with me on that journey of doing so. As a reminder, all mailbag episode tomorrow on Friday, May 9th. Keep your questions coming, and I appreciate all of the thoughtful questions over time. In the meantime, have a great evening. And remember, it's always a good time to own good charts. Good night, folks.